Okay, so we're going to go live in 5, 4, 3, 2, 1.
Recording in progress.
Okay, so 1 second. Okay. Olivier, go ahead.
You know, the IMF produces and it has conceptually 2 parts. The first one is a chapter which describes what's happening and what may happen, and then 2 more specialized chapters which look at the current issues in more depth. And the purpose of this webinar is to actually present and then discuss these 2 chapters. We are very honored that the IMF decided to rely on us to do the first presentation of these chapters. The way the choreography of this webinar is going to go is that the authors of each of the 2 chapters are going to present the main results for 5 to 10 minutes. Then Penny Goldberg and I will briefly discuss the content of these chapters and our reactions to it. And then there'll be a Q&A, which is open to everybody. The way you do it is that you write the questions in the chat, and then I'll try my best to ask as many of the questions in the chat as I can, and then we'll end at the end of the hour. At the same time as this webinar is taking place, the 2 chapters are actually put on the web at imf.org, and clearly not doing the webinar, but just after, you're more than welcome to actually look at them in more detail. So the 2 topics that we're going to deal with today are highly relevant. The first one is about wage dynamics and wage spirals, and the second is about the interaction between measures to fight global warming and macro, with a focus on the short run. The first chapter is going to be presented, if I understand, by John Bluedorn, and I'm going to give him the floor. John is the Deputy Division Director of the wheel at the IMF. John, please go ahead.
Thanks, Olivier. So let me get my slides going. And I will share the screen here. And hopefully you can all see okay. Okay. All right, let me move this. Great. So, well, thanks very much, Olivier and the Peterson Institute, for the opportunity to present some of the key findings from our first analytical chapter of the WIO on wage dynamics. It reflects the work of a great team of IMF colleagues that are listed here. The motivation to undertake the analysis is pretty clear. Inflation has been reaching 40-year highs in some economies, and labor markets have been very tight, raising concerns that the economy could get into a wage price spiral of continually rising inflation and wage growth. Against this backdrop, this chapter examined 3 broad questions. First, what does history tell us about wages and prices after episodes similar to today's? Second, how well has recent nominal wage growth been explained by inflation expectations and labor market conditions? And third, could wage and price pressures post-COVID lead to high and persistent wage and price inflation? We looked at these questions through a mix of empirical and model-based analyses, Given the time constraints, I'm going to highlight just a selected set of the findings from the chapter. So first, let's look at how wage and price dynamics in the COVID recovery compared to the past. Since 2021, inflation has moved much higher on average than it was pre-COVID, while nominal wages, here on a per worker basis, have seemed to go back to their earlier trend on average. Looking back in time, we identified 22 earlier episodes exhibiting a configuration of inflation, wage growth, and unemployment paths similar to those over 2021. Specifically, we looked for episodes in advanced economies where the following conditions held for at least 3 out of a block of the previous 4 quarters. Rising inflation, nominal wage growth was positive, real wages were flat or falling, and unemployment was flat or falling. After these periods of rising inflation, but flat or falling real wages, inflation tended to fall on average, and that's shown by the blue lines here. While unemployment tended to go down a bit, nominal wage growth tended to increase and real wages also increased. Importantly, we do not see signs of a wage price spiral emerging in these past similar episodes on average. However, there is a wide distribution across the episodes. That's the shaded areas here. And in fact, the episode starting in 1979 Q2 for the United States is an extreme case worth highlighting. Here, inflation continued to rise rapidly for 4 quarters after period 0 before it started to come down. Unemployment also rose more than during other identified episodes. After this episode, US monetary policy was tightened aggressively, which contributed to bringing inflation down, but also unemployment up. Notably, nominal wage growth was relatively flat during this episode, contributing to an initial decline in real wages, which then turned around as monetary tightening brought down inflation. Similar to the average case, we don't see signs of a wage price spiral taking hold. We also tried to further unpack the drivers of recent wage dynamics. To do that, we estimated wage Phillips curves by economy groups, relating wage growth to inflation expectations, unemployment, and some other variables. With the estimated curves, we decompose the change in wage growth relative to its pre-pandemic level for advanced and emerging market economies, respectively. There are a couple notable features. First, both the crisis and recovery were unique, with the wage Phillips curve relationships actually appearing to break down. That's shown by the very large other category in these. In fact, at the beginning of the pandemic, the drop in wage growth was less prominent than predicted by inflation and unemployment movements in advanced economies. And that was particularly true in the US. In emerging market economies, the drop in wage growth was sharper than predicted by unemployment and inflation expectation changes. Second, in both economy groups, wage growth quickly recovered in 2021 above pre-pandemic levels. But this recovery was mostly in line with observed drops in unemployment and pickup in inflation expectations. By the end of 2021, wage growth did not seem to be abnormally above that predicted by unemployment and inflation, as we can see by the shrinking other category. Nonetheless, we did see an increasing role of inflation expectations that likely continues today. The large unexplained components observed during the COVID shock and recovery reflect the shock's unprecedented and complex multidimensional nature. In other work in the chapter, we used a rich multi-sector, multi-economy model to study the roles of more fundamental shocks over 2020 and 2021, and found some important roles for changes in private savings, commodity prices, and labor supply, among others, in driving wages and prices. Finally, to better understand the prospects for wages and prices given this context, we estimated a model that includes wage and price Phillips curves, and importantly, that can accommodate different processes for how businesses and households form wage and price expectations, which, as mentioned, have grown in importance in explaining wage growth. Here, we show some scenarios calibrated to the US under the announced policy rate paths from the perspective of early 2022, and assuming there are no further shocks. If expectations are rational, that's the dashed lines, that means they incorporate all available economic information, then inflation starts to come down rapidly over the next quarters to reach the 2% target, with expectations coming back very fast. At the same time, the real wage declines, but does not fall so far before starting to come back. In contrast, if expectations are fully adaptive, that's the red line here, and what that means is future expectations basically shift 1-for-1 with the latest inflation and wage growth. A much more unfavorable path for the economy evolves. Inflation keeps rising for a few quarters and nominal wage growth picks up, but not enough to prevent a large deterioration in real wages. Inflation ends up de-anchored and well above target for many years. Reality is likely between these extremes. If businesses and households learn about the economy using information over the past few quarters to shape their expectations, which we call adaptive learning, and that's the blue lines here, then inflation comes down, but only very gradually, remaining somewhat above target for a prolonged period. Real wages deteriorate initially, but stabilize as nominal wage growth stays steady while inflation declines. Note that with even fully adaptive expectations, we do not see persistent wage price spirals emerge with the cost push shocks coming from outside the labor market. In fact, by lowering businesses' real costs, real wage dynamics help to slow inflation. Even so, the scenarios do suggest that it is very possible for inflation and expectations to become de-anchored from target if monetary policy is not sufficiently responsive. And in further analysis, we show this. The more backward-looking expectations are, the more front-loaded and stronger monetary tightening needs to be to bring inflation back to target. To wrap up, I would just, this just highlights some of the key findings here that I'll zoom in actually on the last one in the interest of time. And that's this one on the future wage and price developments being dependent on how expectations are formed. Our analysis suggests, right, that the risk of any wage price spiral is low on average since the underlying inflationary shocks do not come from the labor market. The negative real wage gap is actually helping slow inflation and expectations in this case. We also would see, though, that the monetary policy response to this inflationary environment should depend on whether wage and price expectations are more or less adaptive. The more backward-looking they are, the stronger the tightening will need to be to avoid inflation staying above target for a prolonged period, and also ensure that real wages don't fall too much. So the concluding message to take away here is that policymakers have to walk a narrow path, tightening to manage inflation and expectations without having too much of an adverse effect on labor markets. And I'll conclude there. Thanks.
Thank you very much, John. It's a lot of material to absorb in a few minutes, and you were very good at keeping time. So I hope that we go further down in the Q&A part. The second paper is about the short-run macro effects of the various measures that we need to take in order to fight global warming. And if I understand, it's going to be presented by Benjamin Carton. And Benjamin, this is yours.
Thank you so much for the ability to present this second article chapter of the World Economic Outlook. So the chapter is really focused on the macroeconomic impact of decarbonization policies. And the chapter starts by stating really the obvious. By the end of these decades, the global economy must reduce emission by at least 25% to have a chance to reach the goals set in Paris. This is fast, but still feasible, and the only requirement is we have to start now. So we analyze the transition, the reduction of emission, and the near-term macroeconomic impact of this transition. And the chapter has a few main messages. The first one is the rapid transition is necessary and we have some cost, but those costs are manageable. We have to start now and phase this policy gradually to minimize the toll, and gradual policies are really key to reduce the cost of those policies. Our estimates points to between 0.15 and 0.25 percentage point of global growth, and between 0.1 and 0.4 more inflation by the end of the decade. But there are very different between regions, policies, and uncertainty around those numbers. So first, costs are very variable across countries. The design of policy package matters, and particularly being gradual and credible. And last, they have uncertainty here around those numbers coming from the ability of the energy sector to reduce emissions. The main message is, as long as climate policies have a limited impact on output and inflation, they do not represent a significant challenge for monetary policy. But further procrastination will only increase the cost of the transition and will start to really be a challenge for monetary policy. Let me move more in depth on a few aspects of the chapter. So the chapter answers like two main questions. Number one is which policies we need to get 25% reduction of emission by 2030. And the second one is what are the likely impact on GDP and inflation in the near term of these policies. Three important factors shaping those numbers. The first one is the economic structure and the initial energy mix of each country, each region. The same objective for each country and region requires very different policies and have very different macroeconomic impact. And we assume to make the same 25% reduction for a comparison purpose. It's clearly not a policy recommendation. Actually, it may even give arguments to have a fairer and more fair burden sharing among countries. Second, the design of policies, particularly the balance between positive incentives, subsidies, public investment, and negative incentives like regulation, emission trading system, or GHG price, all the finance choices you may have, new taxes to finance investment, how you recycle the revenue from a GHG tax if you do that. All these policies matters, or the whole package matters. And third, you have a large uncertainty related to how easy, how difficult is the transition in the energy sector. And so the main question we have is like, for a given reduction of emissions, what is the likely impact on GDP? It's not that complicated actually to square numbers between GHG emission and GDP. And I just want to show you a few aspects of that. First, energy plays a leading role. So to reduce emissions, you have to reduce emissions in energy. And there is two ways to do that. Either you decarbonize energy or you save energy. And the more you decarbonize energy, the less you have to save energy. So it's the split between the two mechanisms is very important for macro impact. The second thing is, if you have less abundant and more expensive energy, then you have to scale down the number of machines using energy in the economy. And this is basically what we call the capital stock. And so one of the channels to reach decarbonization emissions may impact GDP through investment and capital stock accumulation. The charts show here like different numbers for different countries. We have a range of values because we are interested more in not like a single value, or we don't want to give the sense of a precision that we cannot have. But it's a range of reasonable value depending on the initial structure of the economy and how easy, how difficult the transition in the energy sector is. Okay, now I move to the impact on inflation because it's the second important issue. We have three main channels through which inflation may increase because of climate policies. You have the direct impact on consumer prices because households purchase energy. You have an indirect impact on non-energy goods and services because the production cost of firms increase because firms are using energy. And the third main one is second round effects, or what we call the wage price loop, in that higher prices may modify the way firms and employees negotiate wages. On the chart, you have like different values of possible values for inflation on GDP. Inflation is in the red area and GDP is the blue area. And the left one, you have a very favorable case, which is very likely. You have a swift decarbonization in the energy sector. You have a gradual and mild increase in energy prices and very little inflation. This poses absolutely no challenge to monetary policy. And it has nothing to do with what we are currently experiencing, with huge and just over a few months increase in energy prices. In the middle panel, you have, let's say, a less favorable case where it's a little more difficult to decarbonize energy. And because of that, it requires more saving of energy, high energy prices, and more inflation and less growth. But still, you see the numbers, and this is for, for a very reasonable, difficult transition in the energy sector, particularly in the electricity. And the last panel on the right, it's a very unfavorable case where, in addition to difficulty to decarbonize energy, you also have aspect of a wage price loop. You have a de-anchoring of inflation expectation. It comes with further increase in inflation and, more importantly, driving back inflation to target. If this is really what money policy want to do, will come at a higher GDP cost. So the main policy recommendation from that is monetary policy credibility is absolutely key to keep the macroeconomic cost of decarbonization policies very, very manageable. And climate policy design can help reduce inflation risk, so can help money policy here. Let me go to the last case. We currently have high inflation in many countries, and it's already a challenge for money policy. So in the conjuncture, shall we postpone climate policies? It's a very fair question. The answer for us is clearly no. Assume that you want to have the same reduction in 2030 and the same cumulative reduction of emission by 2040 to really keep Paris within reach. Then policies, delayed policies, will have to be much more stringent, phasing much faster, and the GHG price will increase much more and very rapidly. And so the impact on GDP and inflation will be much higher. And I show you on the chart on the right, delayed policy, the macro impact of delayed policies is 2 to 3, even maybe 4 times more important than if we have gradual policies. So really, our conclusion here: waiting is not a solution if you want to address the problem for money policy. Let me go back to the main policy messages. So first, ensuring the temperature remains below 2 degrees will require immediate, credible, transparent, and ambitious action. This as like the main thing from this presentation. Such a major shift in economic structure imposes short-term economic cost. Those costs are dwarfed by innumerable long-term benefits of slowing climate change. But in addition, those policies can be effective and the cost can be lower if we start now, if we act gradually and credibly, and we are sure that we anchor inflation expectation. And this is it for me. Thanks so much for your attention.
Good. Good. Thank you very much, Benjamin. Again, just a gigantic amount of information to absorb. We have officially one discussant, de facto 2, because I decided I would say a few things as well. But the first discussant is Penny Goldberg. Penny is a professor at Yale. but she was also the chief economist of the World Bank from, I think, 2018 to 2020, if I'm right, Penny. And I give you the floor, Penny. Go ahead.
Thank you, Olivier, and thanks also to the Peterson Institute for giving me the opportunity to discuss these very interesting chapters. So let me start by commending the IMF for the choice of topics. I don't think we need to spend much time on motivation, but these are the two most important issues facing the world economy today. So it's great to have the IMF expertise speak to them. So let me start with chapter 2. Chapter 2 focuses on inflation, but on a very specific question, namely, should we be worried about wage price spirals right now? I think this is in everyone's mind. And I would summarize the answer in 2 words, good news. What the chapter shows is that it's unlikely that we'll be faced with price wage spirals. And this conclusion is based on 2 lines of thinking that are closely related. First, if we look at historical experience, what has happened in the past in similar episodes, we don't see such spirals. Whenever we saw them, they were short-lived. One important caveat, actually the authors are very careful to point out the nuances and caveats throughout the chapters, but just to point this out, what we observe, the outcomes we observe are jointly determined by exogenous forces, by exogenous events and policy responses. So what we observe speak to policy responses as much as to what happened in the past. But if we look at these episodes, the message is good. This is reinforced also by regressions that come at the end of the chapter that focus on pass-through of prices on wages. This pass-through is close to 0 for goods. It's about 10% for services. So if I just look at these regressions, having looked at nothing else, I would say the likelihood of such a spiral is very, very low, and that's good news. The second line of thinking, the second piece of evidence is if we estimate the Phillips curve, as John pointed out, the Phillips curve broke down in 2020. This is not surprising given the nature of the shock we faced. But in 2021, it explains the developments quite well. And so the residual is very small. And if you focus on the estimates suggest that expectations are very important, more so than labor market slack. And the good news about this is expectations can be managed by appropriate monetary policy, both directly by communication, but also through interest rate policy. And this has been happening in the last few months. So this is all good news. In general, I find the conclusion credible. I'm on board with this. But let me just point out 2 recent developments that make me a little cautious about predictions for the future. And I would like to point out that in this particular case, this particular inflationary episode, many people got it wrong. Many economists, including Fed officials, these are all very smart people with great training and great credentials. But what we were faced with was a series of overlapping shocks that no one had predicted. So the business of forecasting, needless to say, is extremely hard. But with this in mind, let me point out two developments that I think are specific to our current situation. The first one is that we've seen a shift in attitudes towards work. In economic terms, I would say that what this means is the elasticity of labor supply may be different in the future. Terms such as quiet quitting or great resignation have become standard in the press or in social media. And at this point, it's not clear whether this is just transitory and confined to the US, or whether this is going to be a general trend going forward. So the chapter points out that because of health concerns, many people didn't want to go back to work. I think it goes beyond health concerns. There is demand for work-life balance. As I said, the attitudes have changed. And what this implies for inflation is not quite clear. On one hand, you may say that those employers who are willing to provide better conditions to workers, they may do that in lieu of higher wages. So this may actually constrain further nominal wage growth. On the other hand, there are also firms that may not be able to provide this, that need the workers to come back because they need a face-to-face interaction. And in these cases, nominal wages may have to go up by more. We don't see that yet, simply because I think labor supply has not responded at all. It's not that higher nominal wages bring people back to work. They just don't come back to work. So this is one issue to be careful about. And it's too early to say anything with confidence yet. These are all trends that are unfolding right now. But as an academic, I would like to keep an eye on it, get data from more countries, and see how it evolves over the long run. That said, in my personal opinion, I would speculate that it's unlikely that this would fundamentally alter the conclusions of the chapter. The second trend is more worrisome in my view, and it has to do with this tendency that we've seen, especially in the last year, to decouple from international markets, to redesign supply chains, or to use the more extreme word to deglobalize, reshore or friendshore. I would argue that the reason that we've seen very low inflation in the past 3 decades is this was the age of globalization, including a period of hyperglobalization. And even though econometrically it's very hard to pin down the effects of globalization on prices or wages, I would argue that the global economy, the globalization, had a lot to do with the fact that prices and wages were kept in check. When you may lose your job to someone abroad, to a low-wage country, or to machines, technology was, of course, also important. When you face this risk, you don't bargain very hard. And similarly, firms had constrained pricing power. The attitude towards globalization has changed in the last few years, but especially in the last year since the war in Ukraine. And I'm not so much worried about the direct effect that the war had on energy prices or food prices. We can only hope that this is short-lived, but I'm more worried about the indirect impact on attitudes towards globalization. And if we transition to a regime where the message sent to firms is you are sheltered from foreign competition, and the message sent to workers is your jobs are safe and you should go for good jobs, not the jobs that actually firms need, that may also contribute to rising inflation in the future. And I don't want to sound here like a right-wing hawk. I think there are very good reasons for the policies that are being pursued. There were serious concerns about inequalities, real wage stagnation, and so on. And these are things we all advocated for in the past. But all these initiatives are coming at a point where deglobalizing may actually pose serious risks to inflation. So I would, this is a trend that would actually worry me going forward. There's a third development I didn't touch on so far, which is how do policies to address climate change also interact with inflation? One of the reasons we didn't expect inflation to take off 2 years ago was energy prices were low. This has obviously changed, but what has happened in the last year also shows that energy is important for inflation, and policies to address climate change are going to have implications for energy prices in the short run and also for inflation and growth. And from that point of view, Chapter 3 is extremely valuable. It speaks exactly to this issue. So as I was reading Chapter 2 and I was asking myself this question, it was very natural for me to go directly to Chapter 3. So again, I'm grateful to the IMF for asking these questions that have been in people's minds for a while. I say that Chapter 2, I view the main conclusions as being good news. I actually view the main conclusions of Chapter 3 as being very bleak news for the world economy. And the reason for that is, in my opinion, the realistic scenario is the one that Benjamin showed last, namely the one about delayed implementation. And the one thing the chapter shows is that delays have very serious consequences for both inflation and output growth. As much as I hate to say that, I think policies to increase carbon taxes are politically infeasible right now. No matter how hard economists push for them, we can see what happened in the United States. Worldwide, we see no support for decarbonization policies that are based on price instruments, on taxes, as opposed to subsidies. And so I think this is a sad reality that perhaps we need to acknowledge at this point. So the chapter focuses exclusively on taxes as the instrument, as the relevant instrument for climate policy, and there is a good reason for that. In the short run, this is the instrument that's most likely to make a difference. But if we abstract from what is desirable, what we would support from a normative point of view, and we ask the question, what is feasible? I'm wondering whether we should shift the focus and the discussion completely to other instruments, acknowledging the fact that tax increases or carbon taxes are not going to be implemented in the near future. So this is my main comment, and let me add, two more thoughts on how to go about modeling decarbonization policies. So the chapter borrows very heavily on insights from monetary policy, where it has been shown again and again that it's very important for monetary policy to be credible and time consistent. And the chapter makes a very convincing case that in this case, if monetary policy is convinced it is credible, the costs are manageable, both for output and for inflation. I think the chapter would benefit from drawing also on a different literature on political economy. I think the main reason carbon taxes have not been implemented, at least in the United States, is not that people are so concerned about the macro effects, it's the political economy. States have very different interests. There is not a unified constituency pushing for tax-based instruments to address climate change. So I think political economy has to be the starting point of if we contemplate policies that can actually be implemented in the short run. Secondly, I also think distributional consequences have to be front and center in this discussion. And the chapter does actually a very good job in considering different ways of using the tax revenue. So one of these ways is to compensate low-income households, which are likely to be more affected by regressive taxes. I think this is a step in the right direction, but I would argue that we need to do much more in this direction, not just from a moral point of view or from a distributional point of view, but from a feasibility point of view. If we want these policies to actually be implemented, we have to make sure that they're acceptable to the electorate. And the reason we haven't seen implemented so far is mainly their distributional consequences. So I would argue again that we need to take these distributional consequences within countries much more seriously. And last but not least, so let me, for a moment, wear my old World Bank chief economist hat. I also think we need to talk much more about the consequences, the distributional consequences across countries, with focus on low-income countries. And I agree with the chapter. I fully agree with the authors that the output growth slowdown or the boost in inflation, they're totally manageable for Europe and the United States. But they're not manageable for poor countries or India. And there we have to acknowledge that there is a trade-off, at least in the short run, even though these countries have the most to lose from climate change. So I think perhaps a more nuanced approach towards policies would go a long way towards bringing these countries on board. That said, again, there is a lot of nuance in the chapters, and everything I said, it's actually in the chapter somewhere. So as Benjamin said, these scenarios they consider are not really policy recommendations. They serve as benchmarks, but I would like to emphasize this point that when we are talking about a 25% tax increase across the board, this recommendation is not going to be taken literally as something that should be implemented across the world. If we want these policies to actually be feasible and acceptable, we have to make sure that there is much more tailoring to specific needs of countries and people. So I will stop here, and again, thank you very much for the opportunity to read the chapters and comment on them.
Thanks a lot, Penny. In the interest of time, I'm going to try to be quick, to leave time to the Q&A. By the way, if you have questions, write them down in the Q&A, and I'll do my best to present them. On the wage dynamics and wage spiral chapter, it's, again, as Penny said, it's an extremely topical chapter, and there's a wealth of evidence, and it shows kind of a comparative advantage of the fund, both in terms of human capital. If you look at the list of number of people involved in the project, and the information capital, which is the ability to look at not just one anecdote, but everything which has happened for which we have data, and that's precious. The main conclusion, as Penny said, and as the authors said, is good news, which is that looking at the evidence the way they did, wage price spirals don't seem to have happened on a major scale in episodes not unlike the one that we're going through. And I hope they're right. I'm not absolutely sure. The usual remark, which is episodes are always different, and this one may be different from the others. And the episode that I looked at most, which is 1979, 1981, I think is more complex than what the chapter says. I think it's the most comparable episode we have, at least for the US. I would like to make a conceptual point, which I think points to maybe more work for the team in the future, which is to think about why there is wage push at this stage in the US and other economies. And okay, so it comes initially from an increase in energy and commodity prices. So prices go up first, while wages haven't moved yet. So real wages go down. And then there are two effects. And if you're a nominal wage setter, whether you're a firm or whether you're bargaining, then there are two effects. And I think it's really important to separate them out. The first one I would say is the retrospective issue, which is you've lost some real wage. You have decreased your real income. How much of this are you going to want to make up? So if you lost 5% because price inflation was 5% more than wage inflation, you may want to get the 5% back. And the extent to which you can do it depends on bargaining, depends on the state of the labor market. So it's retrospective. The other is, well, whatever real wage you want to achieve, you have to decide what nominal wage you're going to ask. If you think that price inflation is going to be very high, then you're going to ask for higher nominal wage increases. That's a separate issue conceptually. It's looking forward, what's going to happen to inflation, and therefore what nominal wage do I want to get? These are conceptually different effects. The first one depends very much on perceptions of the past, bargaining power, things like this. The second depends much more on monetary policy, the signal that the central bank is serious about decreasing inflation full time or not. I think the paper doesn't distinguish enough between the two. And it seems to me that at this stage, looking at what's happening, that's really the issue. On the one hand, I think that the Fed looks more and more responsible and committed to a target. So the prospective effect is there. The workers know that there's not, at least believe that there's not going to be inflation forever. But the retrospective part is much less clear. We have overheated labor markets in a number of countries, the US, many European countries. And if the workers want to basically get their real wage back, then they are going to ask for nominal wage increases, and this is going to lead to more inflation. I think that distinction is very important, and I would say, the chapter is a marvelous first step, but you should go further. Let me turn to the decarbonization paper. There has been, fortunately, I think we're having a better sense of what the policies to fight global warming have to be. We have understood that the carbon tax by itself will not do it, that regulation by itself will not do it, subsidies will not do it. We understand that there are distributional effects which have to be dealt with, which Penny talked about. So I think that we're starting to have some plan, which has all these dimensions in it. It has a carbon tax, and that's absolutely essential, but it has other things. Now, I think there has been progress there, but the macro aspect really hasn't been dealt with in any serious way. But what's great about the chapter is that it's really a very good, useful first step to say, okay, suppose we do these things, what are likely to be the effects in the short, the medium, and the long term, although this paper focuses on the short term. And again, here it comes with a number of really interesting conclusions. The first one, and it's an amazing conclusion in a way, which is that if we want to decrease emissions by 25% by 2030, we can do it. And I think many people would have said, can't be done. Now, again, that's based on the model that they are using, and it can be done at a carbon price which struck me as reasonable from a political and economic point of view, which is, if I have it right, basically rises from $0 to about $80 in 2030, which is perfectly within the range, given that there are estimates that we have to go to 200 or more. So here again, I think there is good news. The second good news is, well, we can do this. There'll be a bit lower growth, but nothing really to write up about. I mean, in the range of uncertainties about growth, that's noise. And then the third one is that delay is very costly. Although here, maybe you have played against yourself. Maybe, delay of 1 or 2 years may not be a big issue if we're willing to do the adjustment over 10 years more. It seems to me that the trade-off may be more favorable than it is. But still, it's a really important first step because it's done, quantitatively with a model which has many of the things that we want to have it in. So I really like it. My reaction to it is it's a first step, and I congratulate the fund for doing it. It's a very small first step. The amount of uncertainty about nearly every aspect of the model is gigantic. There is political uncertainty, which means that none of the things that you formalize are going to happen. There's technological uncertainty about the rate of technological progress in new technologies and so on. So it seems to me that the model should be used as a starting point, but being more ambitious about the uncertainty part, saying, well, if this happens, and if this happens. And in the end, I think there are many places where we can discuss. I mean, for example, will investment go down? It's not completely obvious. Investment will go down in dirty energy because there's no point in having it anymore, but it will go up in green energy, and it's a new sector, and maybe there'll be a lot of investment there. Technological progress. It's true that we have to abandon technologies that we know best, which are the dirty energy, but we have a new one in which, yes, we're starting from a lower level, but the rate of growth of technology, of technological progress is gigantic in some of these. So are we going to have more technological progress or less? Now, these are medium run issues, but they are still relevant for the next 10 years. So to the extent that you've defined the short run as more or less 10 years, I think that's very relevant. But I think it's a great start. And again, it's the first serious effort that I see trying to basically look at the macro part. On the inflation part, I'm skeptical that there are any substantial effects of inflation if we do it the way you describe, which is if prices increase by a bit every year because the carbon tax increases. This is just a relative price change, like hundreds of relative price changes that we have all the time in all dimensions. And we think that if it's not enormous relative price changes, which is what we're seeing now because of the Ukraine war, that can be absorbed, and that has basically no effect on the rate of inflation. So here again, I agree. I think if we do it steadily, then it's not going to be an issue. So let me stop here. I give each of you maybe 2 minutes to react to any of the things that Penny and I said, and then I open the floor. I'm going to look at the Q&A. I see that there's a number of questions there. Okay, go ahead. So John, do you want to say anything?
Sure. Yeah, no, thanks very much. Thanks both Penny and Olivier for the really thoughtful comments. And I think if I was going to put it together, both of the sets of comments that you shared on the wage dynamics and this wage price spiral question, I would say that you're pointing out that there may have been structural breaks. This is how I would conceive of it in the wage setting process. In the case of what Penny was saying, it was this, there could be these changes in the attitudes of work, so essentially affecting kind of the labor supply that workers are willing to provide, or there could also be then, and also influencing that marginal decision is this competition from abroad, the deglobalization point that was raised. And then similarly, what Olivier was saying about this possibility of this retrospective or desire to catch up, or and whether or not that's going to be able to be, how important that will be to workers as they bargain. And those as risks, this possibility that there could have been a change in this wage setting process, that those are certainly risks to our assessment, I would say, because we are using what we've seen in the past. Maybe a couple of things to highlight that may provide a little bit of comfort about those. One is that, at least with respect to when we look at kind of the structure of the labor market, there is some evidence. We don't go into it here, but there's another paper by some IMF colleagues, Baba and Lee, that look at it more in depth as to the consequences for wages of energy price shocks in contexts where you have very high levels of collective bargaining or high levels of unionization. And they do find some difference in terms of the nominal wages that are able to, that are negotiated. So you have slightly higher wage growth, but it's very hard to distinguish actually statistically between these two. And they're not, you know, incredibly larger. So to that extent, it suggests that there's still something else potentially going on that could be mitigating that. And the other is then, at least when it comes to the practical kind of implications for, so there could be this change in the wage setting. What does it mean for inflation? I think Penny highlighted that when we look at the past, that's of course conditional on what's happening with policy, and one takeaway could be that policies have been tending to catch up and react appropriately in the past. And that's, I guess, important looking ahead, is that we need to make sure that policy, monetary policy is not complacent in light of these findings. And that in fact, action by monetary policy is actually key to conditioning the result that we don't see these wage price spirals emerging. And I'll leave it there. Thanks.
Thank you, John. Benjamin, very short, because I want to leave some time for discussions. But
actually, I will do it.
Jean-Marc, okay. This is Jean-Marc Natal. He's another co-leader of the project.
Division labor we agreed on. So thanks for the comments and thanks for having us. I think we agree with all of them. Basically, I think just stepping back quickly, reacting to Penny's comment. I think the chapter was started, as a way of background, by the discussion that was taking place in central banks and around the world about the inflationary impact of climate policy. And I think the main message and what comes out of the chapter, as Olivier put it, is that carbon tax don't have much of an effect on inflation. It's a positive message, and the real issue is monetary policy. It could have an effect if there's an issue with monetary policy, and that's, I think, the main message and the background for the chapter. The second issue, the second reason for focusing on carbon tax, and as well as Olivier put it, is that carbon tax should be part of the comprehensive package to deal with decarbonization. Actually, it's also already part of a package in about 45 countries already, and yeah, it takes time to be stepped up. There are issues, and I think you mentioned political economy issue. We fully agree. This is central to any climate policy package, and I think we try to tackle it in a way in the chapter by looking at one important aspect of the political economy is the distributional aspect. You need to get wide acceptance for the policy to be able to get traction and to be able to implement it and to be effective. And the chapter in the model, what we do is we have a package. We have many packages, and in all of them we have a part that is transfers to low income households. The idea is here again, make it palatable and make it acceptable for the largest number is key to make it credible, and again to minimize the effect of carbon tax on the economy. It has to be credible. So carbon tax is good because you can have a whole path ahead of you, and workers and firms can plan. So to have a credible package, you need to have wide acceptance, and this is the way it will be effective and minimize the cost, because agents will adjust.
Jean-Marc, let me stop you, because I want to, and I have questions which are going, so I'm going to come back to you. Penny and I had questions, but I think we're going to pass given the time. I'm going to take some of the questions. I have 13 questions I cannot answer. I cannot ask all of them, but I'll take a few. I think one is climate change is going to imply a lot of reallocation. What implications does this have for unemployment? Is it something that you have in your mind? I'm going to ask the three questions, which we probably have some time to touch. The second is, you assume that all countries basically have to decrease emissions by 25%, but it's clear that that should be different numbers. You've been very explicit. Have you explored simulations in which you basically ask some countries to do more? Basically, the cost of decarbonization is much lower in some poor countries than in rich ones. Have you done anything? And then the last question is, what about the inflation reduction package, or the so-called inflation reduction package? How does it fit your analysis? Have you tried to do simulations which show what it does or it doesn't do with respect to global warming? Now, I think these are three questions. I think given the time, you have 4 minutes to answer them. But let's try to do the best we can. Jean-Marc or Benjamin, I think no questions to you, John. I think there are a few, but I'll pass. Go ahead, Jean-Marc, or go ahead, Benjamin.
Thanks so much. I will try to answer these three questions. So the number one on labor market and the risk of unemployment because of this huge labor reallocation. So obviously, it's one of the concerns we have with our climate policies. Remember, we do gradual policies over a decade, 2 decades. This gives time, and particularly if the policies are credible. Gradual and credible means we know where we go, so everyone in the economy can start to adjust now to things that will happen in 5, 10, 15 years. And this is key to smooth the impact on the labor market. It's one of the reasons why gradual here is very important. Second thing, it's a lot of reallocation. It's inside, for instance, the energy sector, and workers could move inside these energy sectors because the type of skills they have could be very similar, and the cost to train them to move to another is really manageable. The second question of simulation, where some countries do more, some countries do less. Absolutely, we did. It was too much material for the chapter, so limit yourself. And all the comments you made, both Pinelopi and Olivier, and we thank you so much. You are giving us a research agenda for many years, and we agree with most of the directions you're giving. Exactly the type of questions we have, and particularly this question of fairness, how to limit. So preliminary simulations really show that you can reduce the global burden. You can reduce the global cost with a better burden between countries, exactly in the direction you mentioned. The third one about the US package, it came very late. We are not ready to have a full understanding of it. So we will likely prepare something later. So stay tuned on that for the coming month.
Very good. I'm afraid, and we do apologies to the people who have asked questions, but we have to end this webinar now. Let me again thank the IMF teams for the tremendous amount of work that they have done. Let me thank Penny for finding the time in a very busy schedule to look at the papers and discuss them, and Peterson for organizing all this. Good luck. Let's hope that what you say actually happens. Bye. Bye all.